Hey, Mike, how you doing?
I'm good, Maggie. How are you?
I'm good, I'm good. So I wanted to chat with you a minute. This is Mike Kenyon from Union Home Mortgage. He's the branch manager in Leesburg, and he is an expert in what's going on in the market. So I thought we would chat with you briefly to give us an update, and hopefully we'll do these on a regular basis, whether it's weekly or bi-weekly, just so people can get a sense of what's going on in the market since it is so dynamic these days. So I'm gonna hand it over to you.
All right, sounds good. Yeah, absolutely. It changes, it can change hourly.
Yeah,
And we've actually really seen that as COVID really started to build some steam. What would maybe be monthly, and you sort of get like a little bit of an update from China and what's going on there, to weekly and then daily. Um, Things really started to snowball, as everybody obviously saw, back in March.
yep,
And as that's played out, the biggest thing has been unemployment, and that's been kind of the driving factor.
yeah,
It's a different type of unemployment, and this is a different type of financial crisis. It is an economic crisis that is brought on voluntarily to save human lives. So you're bringing on an economic crisis for the sake of saving lives. In one sense, it's very much a no-brainer. Um, but a lot of people are struggling. And
yep.
so it's the types of jobs that are being lost. Now, if you look at those jobs that are being lost, it's a lot of the service industry. So is that really the home buying public? No, not necessarily. So there are certain rates that are, certain loan programs that are really impacted. There are others that are not. Um, the best example I could really kind of give you is, if you think about it, so if you have a loss of employment, what are people trying to do? They're trying to save money. So
Yep.
30-year fixed is really doing great. There's a lot of demand for that. People are going to lower their rate on their 30-year fixed. What we've seen rates kind of pop up on are your shorter term loans. So your 15-year fixed, they haven't decreased at the rate that the 30-year has. They're, even if not, maybe I've seen at times the 30 years better than the 15-year, because why is there demand for a shorter term loan if the payment's going to go up, if the thought is that that person could default because now they have a higher payment?
That's super interesting because initially when COVID started, I think the rates were lower for the shorter term, right? So that's an
Yeah,
interesting dynamic.
it is, and it's just, and that's because the buyers on the security side have changed. There were a lot more buyers there, but as unemployment has really picked up, people have kind of moved out. Well, who's the only buyer left? It's essentially the Fed. And so demand it runs right along with the Fed mortgage-backed buying schedule. So
Yeah.
we have the schedule here. They print it daily. So it depends on what bonds they're buying that day at what given time. And so you'll see the rate come down for that one. It'll go up for another.
Got it.
And so really what I try to advise my clients on, especially those that are already homeowners, is get your application in. We'll queue you up.
Yep.
We'll set our numbers, say, oh, okay, you're at 4%, we'll get you to 3.25. We'll wait till we get there and we'll pull the trigger. The next time you hear me will be when that rate is there, versus we have a conversation. All right, the rate's here. Now we have another conversation, and then you submit the application. Like,
Yep.
you lose too much time doing that, and then you
Yep.
might your window again for another few weeks.
That makes
So
sense. That makes sense.
that's what we've kind of been doing here.
And Mike has a newborn. So
Yeah.
you know, if you're hearing little coos, that's what it is.
Yeah, and my little baby
Yeah,
May.
little May,
Five-
sidekick.
So, COVID obviously is the big driver of this one, but what COVID has brought on is very different from what came from September 11th, where you
Yeah.
saw an enemy and you knew what the enemy was. It's different than the 2008 financial crisis, because that was corporate malfeasance.
Yep.
So these are two different things. This is a public health crisis, where as soon as they wrap their arms around it, it kind of gets under control. The presumption is that the economy is going to come roaring back. I tend to agree. I think it'll look a little bit different. So I think those service industry jobs are the ones that'll probably be most impacted. I think that'll change. As you can see, like Amazon booming, all these delivery places are booming. So
Yeah,
people that
totally.
are in service industry find something else to do. It's sort of that level of employment that is going to shift. I think your
Yeah.
skilled labor and those people that are doctors and attorneys and those, like, they're all going to be fine.
Yeah.
Those
Yeah.
will stay the same. Again, it's the big driver in rates. Different loan programs kind of get different things. What did happen is, though, we had a real big liquidity issue where Fannie and Freddie were really the driving force, and those were the loans that were doing very, very well. And as these businesses really had a lot of trouble, because you had a loan that was backed by Fannie or Freddie, there was a guarantee behind it. And businesses would go and they'd exhaust their lines of credit and they'd pull money out of the banking system. Well, if loans are backed by Fannie and Freddie and those are guaranteed, you're taking money out. So those are kind of okay. That's how the investor looks at it, because, hey, at least I got Fannie Freddie.
Yeah.
Well, jumbo, not so much, because if we'll say Chase or US Bank or whoever it might be, if they can't unload that to somebody else, then they're on the hook for it. So why are they going to do one loan at $1 million where they're servicing one person, where they can turn around and do 4 at 250,000, and they have the option of unloading it to Fannie and Freddie? So you really saw the jumbo market dry up.
That's why. Okay, that's interesting.
It's starting to thaw a little bit. It doesn't look quite like it did before the last time around. It will come back, especially here in the DC area. It's just too big of a player.
Yeah.
So, here it's just a matter of being patient. Side benefit is that Second Trust, those investors that do seconds, they've used it as an opportunity to sharpen their pricing. They've started to offer more loan programs and better rates. And so there have been times where I'll have a second that's lower than the interest rate on the first, just depending on all the dynamics going into it. And so if you can get, that same rate or same loan, the same loan amount that you had on your previous one, but you're breaking it up into two different ones, and part of the rate on it tends to be lower than what you're getting on your first, which is going to be lower than what you had on your jumbo anyway. That's actually a pretty good loan product. I'm doing quite a few refinances right now where we're breaking those up, and it's a home equity line of credit. And now the person actually has something to, as they pay it down, they can do repairs to their home as they come and go.
That's smart.
And now they're just not locked into, if it's a $900,000 or $950,000 loan, just at that rate, you can pay it down a little bit, and okay, well, I can do a new kitchen. So there have been some good things to come from it. You always got to sort of look for these little things that help you along. And I do like I say, I do think jumbo is going to come back. Just going to take time. We lost it for a bit. We did get it back. It doesn't look like it did. The rate's still not fantastic, but it's getting better. So just patience on that one. And again, the seconds, they've done a great job of using that as an opportunity.
So I guess the bottom line here is, if you're interested in either refinancing or you're looking to buy, get your application in so you can monitor how things are going and make the decision to flip when you need to. And hopefully, that coincides with when you find a home. Or for a refi, that's a little bit easier because you can wait a little bit longer to make that work for you.
Right, exactly. I mean, you hit the nail on the head. Get the application in, and you just kind of monitor the Fed buying schedule. And you don't have these long stretches. It might be a week, it might be 2 weeks, it might even be 3, but it's not, you're not talking about months and things like that. So even if you're purchasing a home, the waves have kind of settled down a little bit. It's not as rocky as it was, right in, the first part of March, when this thing really started to take steam. People have sort of settled down a little bit and they can see the waves coming. So that's good. But that whole thing, get your application in, be patient, try not to panic. We're watching it. And if rates pop up a little bit as a purchaser, it can be a little unnerving, you know, don't get me wrong. It's your money, you know, and so if you
Yep.
see rates go up 0.25%, it depends on how risk averse you are. But what I have seen in these past few weeks and, you know, couple months is they've come back down. Just got to kind of watch it a little bit, and again, get the application in and we'll monitor it for you. And then once it's here, like I say, if I've got your app in, I've got it queued up, and then it's just, all right, ready to go. Then it turn around and call you, hey, look, you were at 4%. We got you 3.25. Here we go.
Yep.
And the important thing is, you know, you don't want to get too greedy, because we're right here as the pendulum is swinging. You might catch it near the bottom. You might not catch it at the absolute bottom, but you're going to catch it, you know, really within an eighth or a quarter at most.
Yeah.
You know.
Awesome. So. Well, we'll have your contact information at the end here, and we'll check in again in the next week or so and see how things are going. And I appreciate your time.
Absolutely. Thanks for having me, and I look forward to the next one.
Yeah, me too. Take care.
All
Thanks.
right. Have a good one. Talk to you. Yep. Bye-bye.